Audio Jungle. Audio Jungle.
What is up YouTube, it's Dino here, and today I'm going to be going through how to analyze a property so that you know if it's going to be a good investment or not. Let's get straight into it. So in one of my previous videos I talked about how to buy a property in the UK, the step-by-step process, and in one of those steps it was analyzing a property. Okay, so analyzing the numbers to see if it's going to be a good investment or not. So one of the first things is the actual purchase price. So when you're buying a property, you got to look at the value of the property and how much you're going to actually pay for it. Okay, when you're buying a property, that's how you're initially making your money. What do I mean by this? Well, if the property is valued at 100,000 but you're paying 120,000, you're already paying above the odds for the house. Okay, so it's already bad investment from the get-go. But if you're looking at a property and it's 100,000 and you're paying 80 or 90,000, you could negotiate it to that sort of price, then you're already making a little bit of money because you're paying less than what it's worth. So if you sell it for what it's worth, you've already made, 10,000-20,000 pounds. So how do you find the actual value of the house? Well, there's two things that I use. One is slightly more accurate than the other, but it's good to use both. The first thing is the actual sold prices of the houses in that street or in the very close area nearby in the past 1 or 2 years, depending on how volatile the market is. But look not only for houses in that area, but look for houses that are the same, basically. So same amount of bedroom. If one has a garage and one doesn't, that impacts the price. So look for, if the one that you're going to buy has a garage, look at the other ones that have a garage. Look for houses that are the same style, okay, so detached, semi-detached, terraced, or flats and apartments, okay. Don't combine those, look for the same. So for example, if I'm looking to buy a 2-bed terrace house with no garage that is going for £100,000, then that's what I'm going to compare it against, okay? So I'm going to look for properties that are 2-bed terrace houses on that street or in the very close area, so the next couple of streets, that have sold in the past year or two, depending on, again, on how volatile the market is. If the one that I'm looking to buy is £100,000 asking price and the other ones are selling for around the same, then it might be a good purchase, it might not be. I might need to negotiate the price down a little bit to make it a good purchase if the seller's willing to do that. So that's what you got to look at when you're looking at market value, okay? You got to compare it to make it a fair test to the same style of property for the same bedrooms and with the same features, okay? The second thing is the asking prices of houses up for sale in the same area. So again, it's going to be houses that are 2-bed terrace houses, no garage, nothing like that. So houses that are up for sale, and check those prices. What are they being put up for? Are they being put up for £100,000 as well? Are they put up for more or less, and why? And also look at the condition of the house, okay? So this applies to the houses that are being sold and the houses that are up for sale. So if your house that you're looking to buy is £100,000, but it looks beautiful and immaculate on the inside, then look for houses that are beautiful and immaculate on the inside as well, that are up for sale and that have been sold, and see if they're the same price, because the condition of the house is also very important. Okay, it can make the price go up by a couple of £1,000s, maybe even up to £10,000, £15,000. So if you're looking for a house that is very run down, that's the one that you're looking to buy, then compare it to houses that are sold or are up for sale that are also very run down. Look for the same condition with the same number of bedrooms and the same property type in a very close area or on the same street ideally, and within the last year or two if you can. Try to get as much data and detail about the house so that you know what you're going to buy, if it's going to be at the right value, if you're looking to pay too much, or if you're actually going to get a bargain. Obviously, the idea here is to get a bargain. If you do buy it at the same value of the house, just be aware that you might not be making any money, and also the price of the house might not go up that steep. So if you're buying a house at market value and it doesn't increase, then you're not getting that appreciation aspect of the benefits of buying a house. So if you're just going to look for rent, then that's absolutely fine. But try to get a house that's below market value. That's going to give you a little bit more of an advantage. And if you're looking to fix the house up, rent it, and pull out finance back, then you definitely need to get something that's below market value, so that you can have that buffer of £10,000-20,000, whatever deal you get when you buy the house, so that you can pull out your money back as well. Step number 2 is all about cash flow. Okay, so cash flow is basically the rent that you get minus your expenses, what is left. Okay, is it positive, is it negative, is it zero? Okay, so let's say I buy a house for £100,000. Okay, the rent is £700 a month. Okay, I then take out my mortgage, which will be, say, 200. Let's call it 200, depending on how many years, how good your credit score is, etc. All that sort of stuff's going to influence. But let's call it 200 a month for 30, 40 years, whatever it may be. Then you have to take into account ghost expenses, what I call, which are repair and vacancy. Now, why do I call them ghost expenses? It's because they're not necessarily going to happen every month, okay? But if something big does break in the house, let's talk about repairs a minute. If the boiler breaks in the house, it might cost you £2,000 or more, okay, to fix. That is in 1 month, but it's only likely to break one every couple of years. But let's just calculate it for the year, okay? So then you just divide that 2,000 for the whole year, and that will be into your repairs expense, for example. But usually I like to calculate it at a certain percentage, okay? For vacancy and for repairs. Vacancy is basically when the house is empty and you're not able to rent it. So it might be a month, it might be 2 months, depending on how good the rental market is in your area. So you have to investigate that, maybe speak to some real estate agents, ask them how quickly it is to rent a house in that area, so you get an idea of more or less what you need to calculate for your budget when you're buying a house in your area. So when I calculate these, for me, I calculate at 15% each. So 15% for repairs, 15% of my rent, that is, my gross rent, and 15% for vacancy as well. I also then have a calculation in there for 10% for a property management company. Now, initially, when I'm gonna start investing in property, if it's just 1, 2, maybe 3 properties, I'll look to manage them myself, depending on how far they are from me, depending on a few different aspects, if I'm too busy with work or whatever. But if I am, I'm already putting in that 10% there for a property management company. So property management companies, on average, they tend to be between 8 to 12% of your rent per month for them to be able to manage it and take care of the property for you. Also, you might have to look at stuff like insurance for the property. You know, your tenant might be doing the contents, but you need to cover the building. You might even want to have landlord insurance. So if your rent doesn't come in a certain month, then you can claim in your insurance. Or if your tenants start damaging the property, your insurance might be able to cover that. You have to check the policies that you're looking at and the quotes that you're getting. And from what I've seen, insurances can be around the £20 mark a month for building, and for landlord insurance, they can be roughly that. They can be more, they can be less. So make sure that you're making your calculations on that. So when we're looking at cash flow, you're looking to get your rental figure, okay? Now that, please check again, either on Rightmove or Zoopla. Check the houses in your area. Again, 2-bedroom, terrace house, in the very close vicinity, that are up for rent, see their prices, what they're sort of charging, but also speak to real estate agents, because they'll be able to give you an idea of what they think a house in that condition, in that area, depending on how many bedrooms, etc., can rent for. But let's say it's 700, okay? So £700 minus 15% for repairs, minus 15% for vacancy, minus 10% for property management, and minus insurance, and minus mortgage. It can leave you with around £200, £150, depending on how much your mortgage is and your insurance and all that sort of stuff, okay? So let's say if the house then cash flows at 200 positive, you're left with 200 after those expenses and any other expenses that you might have per month, then the house is, good. It's a good investment. It's going to cash flow 200 or 150 or whatever your figures say, okay? If you're looking for anything lower than that, it might not be worth it, okay? There might be better properties out there. Just keep looking, keep running these numbers on different properties and see which one works out best, okay? The other thing that you can do is then check the ROI, so the return on investment, for that house. So what you would do is you would get your net income, okay, at the end of the month through your calculations. So let's say it's £200, times that by 12 to make it 2,400. You then get that 2,400, divide it by how much money you're putting in up front, so your deposit, your solicitor's fees included, because that counts as well, stamp duty if you're liable for any, okay? Stamp duty is the tax that you pay when you buy a house, and also any renovation fees, so if you need to fix anything before renting out the house. So those four costs are the main four costs that I can think of that you would expect to find in any normal purchase. But if it's not a normal purchase, there might be some extra costs that you might not be aware of, or that you might be aware of, so take those into account as well, okay? So once you've divided your net income, 2,400, by your initial investment, so let's call it 35,000, you then times that by 100 to get a percentage, and that will be your ROI, so your return on investment. The other thing that you have to do also when you're running your numbers is account for inflation and an increase in your mortgage, okay? So bank interests are low at the moment as of the recording of this video, but they do change, and they can change quite rapidly for any sort of reason. And you could be in a fixed term for X amount of time, and when your fixed term finishes, it could then increase by quite a bit. Or if you're on a variable or a tracker, so basically you go with whatever the interest rates change as they go, then it can change at any time. It can go up, it can go down. So when you're getting a mortgage, and the mortgage company or the bank that you go to, they will also look at this calculation, but it's called the stress test. And basically what it is calculating to see if the rent can cover 125% of the mortgage, so 25% more than what the actual mortgage is. So how do you do this calculation? So the way you do this is you do the loan amount times 5.5% divided by 12, and then times that by 125%, and that will give you how much your mortgage will be if it's at 125% of the normal rate. But look for quotes online as well, so you get a good idea of what mortgage products are out there and how much they cost, and take this into your calculations, okay? Don't just fudge figures off the top of your head, or make numbers up, or change the numbers from what they are in reality, because if you do that, you are going to very, very much regret it in the future. If you buy that property, the numbers don't work out, and then every month you're out of pocket £100, £200, £300, £400, depending on how much you skewed the numbers by. Okay, so please make sure that when you're looking at a property, don't get any sentimental attachment or emotional attachment to the property. Strictly business if it's an investment property, okay? So analyze the numbers, but make sure they are the real numbers, okay? If you're seeing quotes for 200 on a mortgage, don't say, oh, the mortgage might be around 100, £150, because it's not. okay? It's 200. Don't change the numbers in your head just because you really like that house and you really want it and you really want to rent it out. It might not be a good investment, okay? And if it's not, then be real with yourself and save yourself pain, heartache, and stress and money. Hope you enjoyed that video. I hope it was helpful, guys. If you do have any questions, comment down below. I'll try and reply as best as I can. If I keep getting the same questions over and over again, I might make a video to try and help you with those questions specifically. But other than that, I hope you enjoyed it, and I'll see you next time.